In this video, we're going to talk about one of the most important concepts you need to learn for this entire course. This is so important, and once you understand why this is important, you'll understand why this, coupled with the strategies we talk about throughout this course, will help you achieve financial independence significantly ahead of schedule, and why this will help you grow your index fund portfolio to the next level significantly faster than someone who does not employ this strategy. Let's jump into it. The concept is called dollar cost averaging. DCA for short. Dollar cost averaging is a method that shows how to invest into the stock market. To understand how dollar cost averaging works, let's look at the other method of investing known as lump sum investing. For example, let's say you get $1,200. You could take this entire $1,200 and invest all at once into the stock market. So this could be great, right? The market's going up, down, up, down. If you invested $1,200 right here, that is great. That means you were able to ride out the entire ups and downs. And so now this $1,200 is maybe, let's say, $2,000. But this involves being extremely lucky and timing the market, which is not what the point of this course is. So most likely you will not be able to pick the actual bottom to ride it out. Oftentimes what happens is, the market's going up and down like this. You may end up investing right here at the top, and now your $1,200 dropped to here. Yes, it goes up, then drops, and you're just kind of at the mercy of the market since it's going up and down over and over again. So this is where dollar cost averaging comes in. What if instead of investing the entire $1,200 at once, what if you break it up into 12 $100 increments? So this way, right here, you would invest 100. Right here, you invest 100. Goes down, it doesn't matter because you invest 100. Goes up, it doesn't matter, you invest 100. You do this over and over again, and you put away money every single month or every single week, just basically as long as it's on a set schedule. This is actually easier for you as well because everything's automated, so you don't even have to worry about when to transfer money. It automatically gets transferred and you could completely be hands off. Now, again, why would you want to do this? Let's look at an example. Let's say you have $100, right? You want to buy a stock right now. It's trading at $50. So now with this $100, you could actually buy 2 shares, right? Now let's say next month, and I'm using this for illustration purposes only, you should not be investing in stocks that are this volatile, but let's say the stock goes down to $33. Now with the same $100, you can now buy 3 shares. And then let's say the stock continues going down, now it's at 25. Now you can buy 4 shares. And of course, if it continues going down to 10, you could now buy 10 shares. So overall, you're getting 5 plus 4, that's 9, plus 10, that is 19 shares. And you invested a total of $400. So the average price comes to about $21 a share. Now this is with the dollar cost average method. Let's compare this to the lump sum so we could figure out why we don't use lump sum and we use dollar cost average. Now with the lump sum, let's say you have that $400, and that's because this is broken up into 4 months. And let's say when the stock was at $50, you were able to buy 8 shares with this $400. So what happens is, in this scenario here, the stock just needs to recover from $10 past 21 and you'll be broken even at $21. So if the stock's trading at 25, you would be making a $4 profit. As for in this situation, the market has to recover all the way from $10 all the way up to 50 to just break even. And so all dollar cost averaging does is that it diversifies your risk over time. That is the biggest reason we use dollar cost average. Another thing I really like about dollar cost averaging is that you don't have to predict where the bottom of the market is. Because you know that regardless of what's going to happen, you're going to invest that $100 every single month because it doesn't matter what the market's going to do. If the market goes down, great, you're able to buy 4 shares. If the market goes up, great, you buy 3. Market continues going up, great, you buy 2. It doesn't matter because it takes all the guesswork out of it. You just know you're accumulating more shares as the stock price goes down, and you accumulate less shares if the stock price goes up. But overall, by doing this, you're averaging your risk and you're reducing your risk. You're actually averaging a lower price, which overall is going to help you become wealthy in the long run. So that's why we do not use lump sum, and that's why we use dollar cost average. Of course, there are times to use lump sum if you have significant amounts of money and you need to start deploying it because of opportunity cost. Lump sum may make sense. Maybe you could do half and half. There are times to do lump sum, but I personally like dollar cost average. Now, you may or may not know this, but if you have a 401k or 403b at work where you're investing into index funds for your retirement account, you are actually dollar cost averaging, right? Every 2 weeks you get paid, a portion of that goes into your investment accounts. That's great. That means regardless of what's happening in the market, you're buying more shares of a certain fund in your retirement account at a lower and lower price because the market's going down. But if the market's going up, you're buying less and less shares. So that's great, right? You're buying all these incredible companies at a lower price. And that's exactly what you need to be doing as a long-term buy and hold investor. Dollar cost averaging is an incredible strategy, and it is part of the backbone for the rest of this course. So make sure you understand it, make sure you continue doing it, and it will help you get significantly better financial results. If you have any questions on this, just leave a question below and I'll be more than happy to answer. I'll see you in the next video.